Hi, everyone. Thank you for joining me today for our Beyond Investment Illusions webinar. My name is Jacob Merk, and I am the Vice President of Investment Strategy at Provident Financial Consultants located here in Oshkosh, Wisconsin. And in today, we're hearing a lot about market volatility, especially given how the stock market has started 2022. And so today, I wanted everyone to hopefully recognize these investment illusions that can be created by the media outlets, whether you're reading it on an article online or watching it on TV. So let's jump right into the material today. And as you can see on the first slide here, the title of the presentation is Beyond Investment Illusions. Now, some of you might be wondering, what is an illusion, or just need a quick refresher? An illusion is a false or misleading perception or belief. It's something that we think we see. It's something that our brain causes us to have a reaction about, when in reality, it is not taking place. So we're going to start off with an illusion. We're going to have some fun with this throughout this period of time. And this is one of my favorite ones. So I'm going to ask everyone to look at the dollar sign in the middle of the presentation. And then I want you to move your head closer to the screen and then back your way out. Just do this a few times. Just get closer, but staying fixated on that dollar sign. After you've been doing this for a little while, does everyone see all the little things spiraling around the dollar sign? Are they actually moving? No, they're really not. They're all fixated on this page here. They're not moving one bit. It's just our brain's reaction to telling us that these things are moving around the dollar sign. Another illusion that I think is kind of fun to look at is this illusion makes us see things that aren't really there. We see on the screen the black boxes and the white dots. And as we look at it, do you see the white dots starting to flicker as gray dots? Are those dots gray, and are they really flickering? No, they're not flickering. They're all staying white, but it's our brain, again, playing another trick on us, causing us to think that these white dots are turning gray as we kind of look across the screen. So it's fun to look at some different illustrations and things of that nature. But again, why we're here today is talk about the investment illusions. And one of the things that we talk a lot in the investment world is volatility. Again, it's been very prevalent to start 2022, and the reaction and the results it can have to our investment decisions. To most investors, even those who invest in equities, volatility is something to be avoided. Now, that when I say equities, think of equities as stocks. They're the exact same thing, so I might use them interchangeably throughout today's presentation. But if you get hung up, equity is the same thing as a stock. And as you look at the graph of the S&P 500, which again is the largest 500 companies in the United States, from 1981 to 2020, again, that's over a 40-year period, would you feel great investing in this market? And as you can see on the presentation here, there's a lot of times that in a 1 quarter, so in a 3 months period of time, the market's gone down over 20%. And that can be pretty scary. And so that's where most people, when this slide is shown to them, want to invest in a market like this. It looks too scary. People don't want to look at the up bars, which again was majority of the time. They become fixated on those big down drops in the stock market where they could lose big. And that's the typical reaction to volatile markets, to get out of stocks altogether. And that's the illusion, that volatility must be feared, when in reality it shouldn't. Most investors desire more consistency than what this chart of the S&P 500 demonstrates. Given that the index has an average annual return of 11.5% from 1980 through the end of 2020, many investors may expect a similar return in an individual year. However, the index only returned between 9 and 12% annually, only 3 times over that period of time. So as you can see from this chart here, it was usually well above 11.5% or down significantly under 11.5%, and there wasn't much right around the average annual return. And that is the biggest illusion, and the aversion to volatility is that many investors forget that volatility represents the potential for a gain as much as it represents the potential for a loss. Even more important, some investors fail to remember that short-term volatility, whether it be over a day, week, month, or even a year, it is still short-term. And yes, some of you may think a year is not that short. That's not the shortest time frame, but when we're looking at retirement planning over 30, 40 plus years, 1 year is a very short period of time. So now let's talk about the reality. This chart reveals that volatility should be expected and also embraced. This graph is the same one that we just looked at. It's the S&P 500 over the last 40 years. Yet instead of looking at the quarterly returns, we're looking at the total growth. And we find that the $10,000 investment in 1981 is worth over $777,000 at the end of 2020. And that's what I call reward and the reality that you would have gotten for enduring all that volatility, significant growth of your long-term assets. And so that is why creating a portfolio that is properly diversified across multiple different asset classes and investment styles can help reduce the volatility while helping keeping you on track for your long-term financial goals. So now let's talk about these two different approaches that investors can have when discussing volatility. One can embrace it, or you can be afraid of it. So we'll look at two different investors. We're going to look at investor A, and we're going to call investor A apprehensive Al. Then we're going to look at investor O, and we're going to call him opportunistic Oscar. Now, apprehensive Al's strategy is he's going to invest $10,000 in the beginning of 1980. And he's very adverse to risk. He doesn't like market volatility. So every time the market and the S&P 500 drops 8% in 1 month, he's going to take $2,000 out of the S&P 500 and put it into T-bills. Again, that's another conservative investment that is out there. So he's going to do that every time we see some short-term volatility. He's going to take out of the stock market and put it into T-bills. So his initial investment of $10,000 in 1980 would now be worth $468,000 at the end of 2020. But let's look if investor O that embraces volatility and views it as an opportunity. So again, opportunistic Oscar, if he invests that same $10,000 in 1980, but every time the market drops 8%, so again, the S&P 500 drops 8% in 1 month, he's going to add an additional $2,000 every time that happens. So over this 40-year period of time, this happens 17 times. So Oscar is going to invest an additional $34,000 into the stock market because he's going to embrace the volatility. So at the end of 2020, his portfolio isn't $468,000, it's over $1.5 million. And that's the reward he received for embracing volatility. Again, volatility sometimes can be scary. We think it needs to be feared, but in reality, it needs to be expected and embraced. So if we take a look at different types of investments and what returns we've seen over the last 40 years, the MIT Age Lab, they talk a lot about investor behavior. And what they often find is that folks' biggest fear is losing money. Would everyone agree with that that's listening today? Nobody likes losing money. Not even people that have a long-term mindset. No one likes to see their balances of their accounts go down. But what the MIT Age Lab tells us our biggest fear really should be is not having enough or running out of money in retirement. When it comes to financial planning, we tend to underestimate the impact of longevity. Now, nobody knows exactly how long they're going to live, but I'll give you a rule to consider when it comes to planning for your retirement in long-term financial planning and how many years you may actually spend in retirement. I call it the rule of 63-36. So essentially what it says is that if you're a 65-year-old couple today, there is a 63% chance that one of you will live to the age of 90. And then there's a 36% chance that one of you will live to the age of 95. That is a long time to spend in retirement. And if you retire sooner than 65, we see people retire at 62, 60, even 55 sometimes. So if you retire, let's say even at 55, and one of you may live to age 95, that could be 40 years in retirement that you need to rely on your assets to keep the same amount of spending that you want to keep doing throughout your whole retirement. So we need to start shifting our thought process to long-term financial planning and the fears that we have, and ask ourselves, can we properly invest to meet those longevity needs? So we'll take a look at a couple of examples. We have stocks, we have bonds, and then we have our cash returns that when you look at this chart here. There are some pretty good returns that we see over the last 40 years. So again, from 1981 to the end of 2020, stocks were up 11.5%. Bonds were earning around 9.5%. And cash was almost near 4% rate of return. And I know a lot of you are probably wondering where you can get a 4% return on your investment in a CD right now. We all know that doesn't exist at this point in time, but when we look over the 40 years, that's been the average return. But even if we're looking at these returns, and let's just say you do receive a 4% rate of return on your cash investment, we're missing something. There are some other risks that are out there. There's taxes and inflation. So the illusion here is that in reality, these returns may not be as good as we are seeing and as they appear on the screen. So what happens when we factor in one of these risks and we factor in inflation? Our returns go down significantly. Stocks drop over 11.5% down to 8.47%. Bonds go from just under 9.5% down to 6.4%. And then our safe cash return drops under 4%, from under 4% down to 1.13%. And that's what we call a real return once we factor in inflation. So can we really plan for the 30, 40 years that we're living in retirement with our money only really earning a little over 1%? So let me give you another rule to think about when we're talking about long-term growth of our money and what to expect in our retirement. And so we're going to use the rule of 72. And the rule of 72 says that if you take the number 72 and divide it by your average annual return, that's how long it will take for you to double your money. So for example, if you think your average annual rate of return is going to be 8%, we'll take the number 72 divided by 8, which equals 9 years. So if you assume an 8% rate of return is what you're going to receive on your retirement assets, it would take you 9 years for you to double your money. So I was talking about this with my grandmother a few years ago, and she was taking a look at wanting to reinvest some of the money that she just received from a CD. And I said, Grandma, forget about the money that you have right now. Let's think of something tangible, something that we can hold in our hands. So I went in my wallet, and it was one of the few times I actually had cash in my billfold. I took out my $100 bill and I said, if I have this $100 bill and I invest it, now is generous. Again, we know interest rates and what we can get in a CD right now. And let's say I invest it at 2%. That's what I'm going to get in my next CD, which is probably more than double what we get. If I take that $100 bill and invest it at 2%, how long will it be until I get $200 from that $100? Well, again, if we use the old rule, rule of 72, 72 divided by 2 is 36 years. So it'll take 36 years from today for me to double my money. And she looked at me, she said, that's a pretty long time. I said, yes, it is. Think about this. In 36 years, will $200 buy you the same amount of stuff that $100 will buy you today? She looked at me crazily and said, absolutely not. Thinking back 36 years, and she went on and on about how today's cars cost more than her first house, and we went down memory road together, and that story keeps going on. But we've all heard things like that, right? That we look back over the last 20, 30 years and how expensive things are today comparative to what they were. And so that's where, based on the inflation adjusted returns that we looked at on the previous page, we take a look on this slide, how many years it will take for you to reach your goals. How long $100,000 would double to $200,000. And so the cash, it takes you the longest period of time at 61 years. And then equities or stocks, it takes you a little bit more than 8 years to double your money if we receive the average annual returns that we've seen over the last 40 years. So for our long-term financial planning, we should consider these risks: inflation risk, tax risk, longevity risk, because they have a significant impact on the purchasing power of our money. We want to make sure that we have a proper asset allocation to grow our assets so we might enjoy the quality of life that we're looking for as we continue to live longer and longer and longer in retirement. A well-planned, diversified portfolio can help both meet your goals and risk tolerance, while helping address concerns about inflation, taxes, and longevity. So we haven't looked at an illusion for a while, so here's our next one for today. And here's this illusion: bulls and bears are predictable. I hear this a lot from clients, other investors, in the media, and they say, well, I'm just going to time the market. Right before it gets bad, I'm going to get out of the stock market and I'm going to put into conservative investment, and I'll come back when the stock market's about to do well. It's this kind of illusion. It looks like it can be a real object, but the more we look at it, we discover it's an impossible shape that could not exist in reality. So again, as you look at this page, we all know that this shape could not exist in our world. So that's the illusion. And we'll show this with the history of the market, shows a very neatly separated bulls and bears. And the bears seem to pale in comparison to the bulls. Why not try to hit only the bulls and avoid the bears? Many investors believe that there must be some indicators out in the market when to buy and then when to sell stocks. Since the greatest gains for bull markets have historically been at the beginning of a bull market, the question becomes, how quickly can investors identify a new bull market? Since World War II, on this page here, so we're looking from 1950, there have been 13 bull markets and 12 bear markets. The comparatively small size of the bear markets in the chart above can be deceptive. Keep in mind that a bull must work twice as hard to make up for the previous bear. For example, if a bull market return is 100%, a bear market only needs to decline 50% for this investment to be back to its pre-bull value. This graph shows a hypothetical return of $10,000 again in the S&P 500 starting in 1950, and that $10,000 would have grown to $22 million by the end of 2020 by simply not trying to time the markets and just investing and embracing the volatility that the stock market can bring. So historically, market timers seeking to avoid the downturns of a bear market would have missed the vast majority of the market's best days shown on the slide here. Most of the best days occurred actually during a bear market or within the first 2 months of a bull market, when it's nearly impossible to tell whether a bull market has truly arrived. From 1991 to 2020, half of the market's best days occurred during a bear market. Now, that might be shocking to some of you, but I know when I first looked at it, it was it opened my eyes as well. So essentially saying during this time frame, if we pulled out our dollars out of the stock market and we sat in a cash investment, we would have missed some of the best days in the market. And that can have a significant negative impact to our overall return within our accounts. So take a look at it in a different way. Instead of just looking at the percentage of days of where we saw the best market, what if you actually lost or were just not investing, you missed out on some of the best days and months of the stock market? So what are the consequences of missing some of the best months or days? And some of you might scoff at the idea of just missing out a few days, but again, as you can see on this chart here, it can be a big impact. If you miss too many of them, you would have been better investing into low risk treasury bills rather than trying to be in the market and trying to time when to get in and out of the stock market. And so looking at these returns, we see the costs associated with missing the best months or days on the market. On the top graph, we start seeing an average return of 10.6. And then as we miss the best 5 months, 10 months, etc., we see the returns go down. And on the lower graph, it's the same thing, but we're just looking at days instead of months. If you miss too many of these best days or months, again, you'd be better off by just staying in a safe investment for the entire period of time. And that's the significant cost of trying to time the market. It is wise to have a goals-based plan and stick with it throughout time and not feed into the emotions that can cause us to get off track and derail us from our long-term financial goals. So this brings us to our second last illusion that we'll look at today. And this is going to be talking about chasing winners. In other words, putting our money into investments that have done great recently. That seems like to make the most sound investment decision. It makes a lot of sense. Everybody loves being behind or investing in a winner. But while picking winners seems like a rational approach, it often doesn't give the results we expect. It's like this graphic. When we look at it, it looks weird and the lines are bent. Does everyone see that? And again, it doesn't look like any of the lines are straight. But believe it or not, the grid lines are all straight in this pattern. If you don't believe me, I'll keep this up for a second or two where you can take your sheet of paper or ruler to make sure of that. But again, it's the illusion of thinking that something is there when it's really not. So I often hear investors say, I'm going to invest in what's best. I want to invest in the best area of the stock market because it's going to continue to do well. Or I'm just going to find the best investment, whatever has done well, and that's where I'm going to put all my money in, or a significant chunk of my accounts into that type of investment. And that's what we call a rear view mirror approach. Speaking of a rear view mirror approach, how many of you done this? In a real world example, you're sitting in traffic, you're dead stopped, and the lane next to you is going and going and going. You're seeing cars pass you one after another. And so you're trying to now, because you're being stuck and you're getting frustrated seeing other people do well and keep moving in traffic, the first chance you have, you're going to veer off into that lane. And what happens as soon as you get into that next lane? It stops. And the lane that you just were in starts to go, and that was the better lane to be in. So you kind of go back and forth, essentially going nowhere, right? Anyone else have this experience before? I know I've had this when I've gone down to Chicago or Milwaukee in the past, and I get frustrated staying in traffic. You're just trying to be in the best lane so you can keep moving. And that we can sometimes do that same thing with investing. We say, what's the best investment? And I'm going to shift a lot of my money or all of it into that type of investment. So we're going to look back to 2006. So again, over the last 15 years, these are the ones that you see on this page, the best performing asset class for each individual year. So you have large cap stocks, mid cap stocks, bonds, and etc. All the categories shown here were the best performing asset class for that calendar year. Investors, and it's by looking at this, investors typically underperform the market by a wide margin due to timely buy and sell decisions. According to one analyst of investment behavior over the last 20 years, so that was ending in December 31st of 2020, the study found that the average equity investor underperformed the S&P 500 index by 1.5% annually. So that's a big underperformance compared to the stock market. And this study reveals that many investors believe the illusion that the secret to investment success is investing in those winners and having a rear view mirror approach. So this one's a very colorful slide that we have here, again, showing all the different asset classes and how they performed in each calendar year. And then, however, when we look over a period of time and we compare them to other things, what we find is that it is very rare for an asset class to remain on the top row for very long. As a matter of fact, most of the time, the winners end up going to the bottom of the chart. And so when you're looking at this, you can see that we just simply cannot predict what's going to be the best investment in the next year. So again, not a single one of us can accurately predict with 100% certainty what's going to be the best investment in 2022. And we can't certainly do this based on what was the best investment in the previous year. So what did best in 2021? So let me ask you another question. When you're looking at this graph, is there a particular box that sticks out to anyone when they look at this chart? And to me, it's the white box, right? And why does this stick out to me and hopefully all of you that are watching this webinar right now? It was steady. It was consistent. It was right in the middle of this chart throughout the whole period of time. It was never at the top, which might disappoint some of you, but more importantly, where else was it never at the bottom? or I kind of alluded to there, it was never at the bottom of the chart. So this is why the white box is a diversified portfolio of an equal percentage of every other asset class that is listed on this chart. So when we talk about long-term success as an investor, you find that this diversified portfolio not only provided us long-term returns, but it's done so in a much more consistent fashion, where we don't have the angst of trying to pick the winners and losers or what's going to be the best asset class next year or the next 3 or 5 years. You just go into a diversified portfolio and take a little bit of stress off of what investments you should be investing in. So let's look at 3 different investment approaches. And we're going to take a look at if you invest $10,000 every single year from 2006 to 2020. And the first approach we'll look at is you invested in the worst performer. You're thinking, well, if it was at the bottom of the chart, well, it should maybe be at the top of the chart the following year. Some people may do this and some people might think you're crazy for trying to invest in this way, but it's actually done pretty well over the last 15 years. They would have had an ending value of investing $10,000 over the last 15 years with the ending value of $267,000. Not bad. But if you would have invested in the winners and had a rear view mirror approach, you would have done slightly better than investing in the worst performers. You would have had $333,000 by investing in the best performers from the previous year. But again, if you want to try to take the angst out of investing, you simply would have invested in a diversified portfolio, again, that white box with a variety of different asset classes. It might have been a wiser decision, and it had been over the last 15 years from 2006 to 2020. That diversified portfolio would have grown to over $390,000 by just simply riding it through, putting $10,000 every single year. You would have done better than trying to invest in the worst or best performers based on the last year. So I know that we've gone through a lot of great different illusions and things to keep in mind. So let's wrap things up and talk about how you can stay on course and not let these illusions have a negative impact on your investments going forward. First, if you feel uncomfortable during times of volatility, consult with a financial advisor. Oftentimes, having someone to work with can offer perspective and can give you a little bit more education and insight on what's going on in the market. That can help prevent us from falling into some of those reactions we talked about earlier. Second, create a strategy. Oftentimes, we talk to folks, they say that they need long-term financial planning, and it is their number one goal. It's my number one priority, and I have a long-term financial plan. Yet studies show that less than 50% of people have actually sat down and done the retirement calculations to actually figure out how much money they're going to need to save in order to have the lifestyle that they want in retirement. So it's really important to take the time and sit down and make a plan. How many people have planned for more for their last vacation than in their retirement over the last few years? And that's where a lot of people sit there because it's exciting to talk about vacation. It's something very short term. It's something that you maybe have never seen this place before. You're excited to go back. It's, again, shorter horizon and it's more exciting. Where retirement planning can be daunting and that's not going to be for another 20, 30 years for some people. So that's just kind of down the road, and people don't like to be analytical sometimes as well. So it just takes more effort and it's not as exciting as a vacation. But even though we know this, we need to take the time to plan for retirement and actually start coming up with these calculations and coming up with the strategy to help you meet your long-term financial goals. The third one is asset allocation. And again, as we talked about the white box with the diversified portfolio, no one can predict the future, including how well a specific type of investment will perform the next year. A financial professional can help you understand the advantages of how a well-diversified portfolio consisting of a variety of asset classes can help provide more balanced returns. Yet a diversified portfolio means that at any given time, you'll probably be putting money into an asset class that is underperforming or experiencing negative returns. However, that same asset class may very well be the best performer in the near future. And the last approach and something to think about is systematic investing. A long-term systematic investment plan provides several advantages. Some of them are psychological in nature. First, it allows you to take advantage of the normal shifts in the market by purchasing more shares when the market is lower and fewer when the market is higher, which reduces over time the average cost per share for each dollar invested. Second, it strengthens your investment discipline by helping you maintain a long-term perspective. Remember, it's time in the market rather than timing the market. And I know a lot of people out there, myself included, I have auto billing on in my bank account. So my mortgage, my utility bill, things of that nature come directly out of my bank account. Well, you can do the same thing with your retirement savings. On a particular day of the month, you can have the money go right out of your bank account and into a retirement account or another type of investment account. So it's that disciplined approach that can really help you over the long term. So I just wanted to kind of end today. I thought it'd be fun to show one last illusion. No matter how many times I look at this illusion here, I can still see the wheels spinning. So I just wanted to thank you for joining me today. And I hope you've had some fun looking at the different types of illusions and taking a look at some of these illusions that can be given to us by the investment world. One thing that I hope everyone takes away from today is that no one can control the volatility that happens within the market. But the one thing that we can control is how we personally react to it. So try to keep that in mind. And next time that we see volatility, or if it still continues through 2022, try to have a disciplined approach and not get caught up in these illusions. If you have any questions in regards to anything that I said in this presentation or financial planning in general, please email us at info@providentfc.com, and someone from the team will get back to you as shortly as possible. Again, I want to thank you for taking time out of your day today to listen to this presentation, and we look forward to seeing you next month for our webinar. Thank you so much and have a great rest of your day.